percentage of double B rated high yield bonds is the highest it's been in 10 years, with about 60% of the market being lightly levered and offering an attractive return with dollar prices on those instruments in the 70s and 80s. In addition, private credit, certain types of private credit markets are experiencing dislocation given the banks having stepped away from large cap direct lending to leverage buyout sponsors. So there is a widening in the pricing that we're seeing in direct lending, as well as a tightening in the legal protections that are available in direct lending.
It's a buyer's market, that's for sure, and that's a change from what we saw in the last decade. And you mentioned the improving quality of the high yield index, and many people on the same page, we all see the same thing. With that in mind, Armen, can you tell me how you think the index will perform in a downturn relative to how that index has performed in the past?
It's a great question. I think that the index is already predicting some level of a recession. Spreads generally are wide, or on the wide end of normal. Typically, high yield bond spreads are between 300 and 500 basis points. Today, we're on the wider end of that range, which suggests that there's an expectation of some level of risk and default as we head into 2023. So long story short is that some of the risk is already priced in, but I would expect that at some point next year, as we lap tough comps or easy comps in 2022, that we will see improved performance in the back half of 2023 and into 24. And so I think the market, in anticipation of that type of improvement, will likely be ahead of the fundamentals. And I think actually by the time 2023 and 2024 are over, they will be very strong years in terms of index performance. But obviously this year it's been a challenging year for high yield.
Can I work through just the following with you? So we've seen the bulk of the tightening cycle. You've indicated we've started to see the consequence of that. People started to price in the downturn. Can you tell me something, Armen, and this is where I'm really interested. When does the maturity wall start to become a problem? It's certainly not next year, but if the Fed is sticking with this high for longer story, we've had the higher rate story. Let's talk about the longer piece of it. Armen, when does that start to become a problem? Where is that maturity wall on the horizon?
It's really 2027, 2028. If you look at the maturity schedule for high yield bonds, only 6% of that market matures between now and the end of 2024. In the case of broadly syndicated loans, it's a little bit higher. It's about 8.5%, but still quite manageable. But if you were to really dig deep into what subsections or what ratings categories are spread across that maturity profile, it's really the triple C's and lower rated securities that are maturing in the near term. And therefore there will be some level of defaults, but the percentage of triple C's in the market is quite low right now. It's under 10%. So I don't think that there is going to be a maturity-driven default experience in the next 2 years. The maturity wall is substantially extended at this point, and I don't think that we will see defaults driven by maturities. However, with floating rate borrowers in the broadly syndicated loan space, or even in the private credit space, especially in highly levered transactions with LBO sponsors, we will see some level of defaults and losses associated with those credits because they were very aggressively capitalized over the last 2 or 3 years, and they have the added cost of higher cost of borrowing with floating rates rising as rapidly as they have in the last 12 to 24 months.
Armen, this was a clinic. We appreciate it, sir, and let's have a longer conversation next time. That was Armen Panossian there on the credit market. Just to get back to the equity market, about 23 minutes in, equity's down 0.5% on the S&P. On the Nasdaq, we're down about 0.25%. Coming up, the market movement events you need to be watching, the trading diary for the rest of this week. From New York, this is Bloomberg. About 26 minutes into the session, equities declining by 0.5% on the S&P, but down 0.25% on the Nasdaq 100. That's the price action. Here's the trading diary. Fed speak coming up from Williams and Bullard at noon Eastern. US consumer confidence coming up on Tuesday, followed by US GDP and core PCE on Wednesday. Plus we'll hear from Chairman Powell along with Governors Bowman and Cook. A little bit later this week too, jobless claims coming up on Thursday. And finally, we round out the week on Friday with the US payrolls report. In our survey so far, moving target, the median estimate 200k from a previous read of 261. From New York, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Monday, November 28th. Here are the top market stories that we're following for you at this hour. Disorderly exit. Goldman Sachs says there is some chance China crashes out of its zero COVID policy as Xi faces historic protests at home. And the oil plunge, WTI erasing gains for the year as China unrest just sinks commodities. We're going to speak to Christian Malik, JP Morgan and Global Head of Energy Strategy. And measuring recession risk, strategists warn that equities have not fully priced U.S. recession, so we're going to get the global read from the C-suite with GXO, Shopify, and Infineon. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, before we get to all of that, two words for you. Matt Turner.
Max Turner.
Matt Turner. He's the goalie for the U.S. I mean, I know you say the game was boring, but come on. We did so well
Alex,
against you.
There are rumors. You guys won. Like in reality, you guys won.
I know.
It was It was a great weekend for Alex Steele. Not only did she get to effectively win at the football, 0-0 draw. Wow, was that boring. But you went shopping as well. How was the shopping?
Well,
I'm trying to change the subject.
I know.
How was the shopping?
You know I worked so hard to remember that name for you. You're just moving right on. Shopping was fabulous. Actually, the deals were really good. Good for me, bad for retailers.
Yep.
If I'm that contrarian indicator, you can read through that what you will for margins.
So this is actually one of my takes on the day is that there's a lot of doom and gloom out there. We're going to talk about China in just a moment. The recessionary risk is certainly increasing. But actually, Black Friday looked pretty good. The consumer was pretty strong. People went out and spent serious amounts of money. I don't know whether it was kind of strategic shopping, i.e., like you, people have got their Christmas shopping done and therefore are being kind of strategic in their thinking about it, or whether this is kind of people going out there and buying things they want. I sense it's more of the former than the latter.
Agreed. I mean, case in point, I got a Dyson. Like, that's not like, yay, look at my cute shoes. That's like, look at the deal I just got from Target on my Dyson. Like, so strategic is definitely the way to think about it.
Okay. Alex has bought a vacuum cleaner over shoes. This is a momentous moment for all of us to kind of think about where we are in this cycle. Let's talk about China. We should probably talk about China. So let's get on and talk about what is happening. Clearly, the big market effect today, protests spreading across the country in response to China's COVID-0 policy. Thousands taking to the streets in cities like Shanghai and Wuhan over the weekend. Let's go to Alan Wan in Shanghai for the latest. Alan, update us if you can. Are the protests continuing? How are the authorities reacting?
Well, today actually, we walked around Shanghai, went back to Wuluwushi Road, which is the epicenter of the massive protests over the weekend, and it was pretty quiet, to be honest with you. There was one of the reasons why it was just a massive police presence. It's a Monday, it's a working day, and it's raining. One thing we noticed when we went to Wuluwushi Road, which is where all the protests took place over the weekend, is that the police had retrofitted the area. So now they've actually put in a lot of fences along the sidewalks, preventing people from fleeing, a lot of protests from fleeing into the side streets. And also they took over this workers' dormitory, and they're hanging out there to kick out looks like they kicked out the workers. So today's been pretty quiet in Shanghai as well as Beijing. But, that comes after, last night, thousands of people converging, along this fashionable street in downtown Shanghai and, facing off with hundreds of police. And they were calling for everything from the end of COVID-0 to the release of prisoners, to release of demonstrators from the previous day. I mean, they had organized a peaceful vigil, and they got detained, as well as they've actually made some political grievances as well.
Alan?
So it's been quite tense. Yeah.
Alan, what is the biggest risk here? That the police have more force? That Xi does more of a crackdown? Where's the risk that we need to start paying attention to?
Well, I think there are a lot of risks. I mean, actually, obviously there's a risk of a crackdown. That would send, I think, a lot of foreign investors fleeing. This would be quite surprising in the fact that just a few weeks ago, the government announced a loosening of its COVID restrictions, which actually spurred an inflow of money into China. And now, a couple of weeks later, it looks like there's been a backtracking of some of these COVID easing measures because there's been an upsurge. So there's there's a really, there's a high probability of a crackdown. But then again, on the flip side, maybe this could force the government to sort of, accelerate their exit from COVID-0. A lot of investors have been expecting maybe an exit in around March, right after the National People's Congress. So maybe now there's pressure on the government to accelerate that exit.
Alan, is China ready for an exit from COVID-0? Is the healthcare system ready for the potential numbers of cases that we could see?
Yes, that's the million-dollar question. I mean, that's the biggest concern for the government. There have been some models forecasting about 600,000 deaths that could occur. And, that'll be less than what happened in the U.S. and what you had 1 million deaths in the U.S. But for Xi and China and Chinese government, that's probably unacceptable just because during the beginning of the epidemic, they were sort of like, touting their ability to save people's lives. And now they actually go reverse, really, would be a little bit embarrassing. So yes, and also there's concern about the vaccines, although there's a new inhalable vaccine now that should, encourage more people to get vaccinated. But a big problem, of course, is the elderly, and they're still not getting vaccinated at the high numbers that are necessary to move away from COVID-0.
Alan, look, we really appreciate it. We know it's super late where you are, so thank you for staying up for us. Bloomberg's Alan Wan joining us there. So that leads us to the question of the day. How do you price in China's protests and the evolving zero COVID policy? Joining us now, Bloomberg's Kriti Gupta and Eddie Vandervalt. I'm looking at equities off by, 0.6% for the S&P. Kriti, how do you price this in right now?
You basically pick stocks that are very exposed to China, and our bellwethers for that can be the likes of Apple, Tesla, Nvidia, for example. I mean, just look at the Apple performance right now, down 1.6% at a time that the stock market is only down 0.6%. That is real noticeable underperformance, and of course this comes off headlines that about 6 million units of iPhones. That's the number of the production shortfall that you might have as a result of some of these protests. But it's not just them. Think about Tesla as well. One of the major pros of Tesla, of buying Tesla stock, especially last year, was this idea of supply chain issues. Tesla is known for locating their factories very close to where they can actually get their raw materials, and that has been a boon for them in the past couple of years, specifically as we talk about inflation and supply chain shortages and these sky-high prices in commodities. Those are the kind of stocks that are taking a hit today, and of course the chip sector as a whole, which tends to trade in line with a lot of those Chinese stocks as well as the American tech stocks. But it's not just equities. Look at the commodity market. I think a lot of the pressure that you're seeing in the crude space is a result of China.
Eddie, let's talk about the crude space. Let's try and figure out what is happening here. It is very hard to read what takes place next in China. This could lead to a reopening. This could lead to a huge number of cases. This could lead to a crackdown. Is the crude market basically saying we don't know, therefore we sell?
Yeah, you know what? I think Kriti makes an absolutely perfect point there. And I think, this is the difficulty here is picking your time frame. I think if you're looking at this on a really short-term basis, if you're looking towards the year end, like a lot of portfolio managers are doing, then what you've got to think about is disruption. And short-term disruption is going to affect things like the copper market. It's definitely going to affect things like the crude market. And, that's why we saw energy in the early session down most of all. But I think if you're looking towards the middle of next year, then absolutely, this could probably mean, reopening or, a hard clampdown. All of this will come down to Beijing's reaction. How willing is Beijing to expend political capital to keep people under lockdown, which surely it must know at some point it will have to reopen. And I wonder whether this does not just speed up that process. Yes, Alex?
Well, Eddie, though, I'm wondering, because you hit on oil for a moment. I mean, it's easy to just make the line with China, but I'm also wondering how much of this is we're looking for excuses to sell winners of the year. And energy and oil definitely has been a winner of the year, and I'm wondering how much of that is playing into it, and then China is just the trigger point.
Absolutely. Look, I'm a big believer that crude and copper should be trading together for most of the time because they're driven by much of the same fundamentals. Now, copper is down something like 13% this year. Oil is barely, unchanged on the year. And I think the reason for that is that we've had OPEC intervention and we've had the war in Ukraine. Now, I think as the macroeconomic situation worsens towards next year, I think the crude picture definitely gets more precarious.
Kriti, let me come back to you on that point as well, though. Equity markets have had a decent run recently. We're running into Christmas. Maybe Santa's come a little early, but the momentum's been fairly good. I know that most of the main indexes, certainly in the States, are below the 200-day moving average. But nevertheless, you look at China and you think, I can't quantify this, therefore I'm going to lighten up. But is that just an excuse? You've done well. You're going to lighten up on your positions. You're going to take profit in some of those winners. Is that what we're seeing a little bit of today?
Yeah, I think that's a very fair case to make. The idea here that you're really looking for any excuse to sell. Remember, a lot of the bullishness that you've seen in the last couple of weeks, there is still that massive wall of worry, and a lot of the funds that you would expect to kind of re-enter the market post-midterms actually haven't, and I think that's a real point of concern for the bulls that are looking for that kind of sustainable rally to really stick. I think another piece of the equation, though, is when you do actually perhaps blame China, if you will, or use China as kind of an excuse to sell, is that there is a fundamental reason here. Look at years years of, we're talking about a trade war, but essentially a legacy that this kind of idea of deglobalization, it hasn't taken full effect through a lot of these American corporations in the way that perhaps the overarching geopolitical narrative would suggest. So there is a fundamental case to say, look, if China is dealing with these protests and actively dealing with these production shortfalls, that is going to have a very real read-through into the United States. It's not just sentiment-based.
100%. Then I'm wondering why the VIX is still under 22. And I guess you could make that argument like for the whole year.
Yeah.
But my point being is that we have a lot of risk events this week. We have China. We have a PCE in the U.S. on Thursday. We have inflation reading in Europe on Wednesday. We get jobs on Friday. Like, well, where is the trade here when it comes to volatility and pricing in these risks?
Well, I think this goes back to the issue of active participation in the market because you're not seeing it. There's still a lot of money in the sidelines. And we've been saying this for, I want to say, 2 years now, that no, everyone is actively investing.
Yep.
And that is a problem for the VIX, which a lot of people are now calling a broken gauge. I mean, a 22 handle going towards 20, that's strange.
Yep.
But then take a look at the MOVE index. That could be your substitute.
Yeah, and actually you've certainly seen that being a more useful and accurate way of judging market volatility. Eddie, final quick point to you. We do have a busy week. You've got European CPI coming up. We just had some comments from Christine Lagarde talking about the fact that maybe inflation has yet to peak. You've got PCE, you've got GDP data out of the United States. You've got Jay Powell going to be on deck a little bit later on this week as well, Wednesday. You've got a big Macron meeting in Washington, D.C. What are you going to be looking at? Set us up for your week. How are you thinking about it?
Yeah, absolutely. I think you're right. I think European CPIs are the big one for me because in Europe we haven't had that big downside surprise that we've had in the US yet, and Europe has the added advantage of energy costs coming down really sharply. You know, we've got storage capacity in natural gas sitting near record levels for this point of the year, and I think that's going to start reading through. I think we get that downside surprise, and then the jobs numbers, the big job numbers at the end of the week.
Yep.
I think that will really set us up for the end of the year, and I think Ritty's right. There's money coming back into this market. It's money on the sidelines. A lot of actively managed money that have taken positions and haven't really picked their position yet. And I think we see that coming into the end of the year.
Yep. You would have thought you'd want to be maybe packing up for the year. Christmas is coming. Parties are starting. Maybe there'll be parties this year. Eddie van der
You go to
Walt,
parties?
thank
You
you
don't
very
go to
much
parties.
indeed. I don't go to parties, but maybe people will have parties this year. Haven't had them for a few years. Christmas parties have been off the agenda. People haven't been partying these last few holiday seasons. Kriti Gupta, Eddie van der Walt, great stuff, guys. Thank you very much indeed. Coming up, more on the risks from China. Anna Rathbun, CBIZ Investment Advisory Services Chief Investment Officer, joining us next to discuss. This is Bloomberg.
it's clear to me that Xi cannot tolerate any protests. So there will be a very tough crackdown on any protesters. More people will be arrested, and they will probably go further in terms of control.
That was Mark Mobius at Mobius Capital on how China will respond to widespread unrest. And that leads us to the question of the day: how do you price all of this in right now? Equities down by 0.5% for the S&P. Joining us now is Anna Rathbun, CBIZ Investment Advisory Services Chief Investment Officer. Anna, how do you price this kind of risk of China in? Protests, unprecedented for decades.
I wish I could tell you. I don't think anyone really knows at this time, and I think there's some caution in the markets. I do agree with what was just said about Xi Jinping and the risks in China. I think that if you look at the two different spectrums, Xi Jinping can either completely dissolve his zero COVID policy, which is unlikely, or crack down even harder. I think that is more likely. But I think that some people are making comparisons to the Tiananmen Square massacre, which we hope that doesn't even get close to that, because that would be a humanitarian crisis. But the difference here is that China is now on world stage, and frankly, there are cameras everywhere. That's just the world that we live in. And there's a credibility issue for Xi Jinping here as a partner, economic and political, for the rest of the world. So it probably won't be everybody being let out and Xi Jinping giving in to the demands, but at the same time, I don't think the worst that could happen would happen.
Anna, does it accelerate the fragmentation, though, we're seeing, the deglobalization that we've been seeing? And if so, is that inflationary? And if so, how do I position for that?
Yeah, I do think that it does speed up deglobalization. I would remind everyone that deglobalization actually began in 2018 with the Trump tariffs. So everyone had been thinking about reconstituting their supply chain. At that time, the pandemic made it sort of necessary, right, with the supply chain debacle. And now the political risk is at the center stage in terms of supply chain. So I do think that deglobalization is still a theme. We're not calling for a complete deglobalization, but of course the de-risking of the supply chain. And that is definitely inflationary, because globalization was to reduce prices. So if you undo some of that, that will mean higher prices in the future.
So in the near term, though, and we mentioned this earlier too, how much of the China situation is also an excuse to sell? I mean, there's no technical reason why oil should be down this much in the past couple weeks, or why the S&P should be off 0.5 based on what we saw over the weekend. Is there a fundamental reason on that front, or is this just about selling risk into the end of the year?
I think there is fundamental reason. Number one, if you go back to Xi Jinping's speech from October, he makes it very clear that zero COVID policy stays. And I think that is what the oil markets have been pricing in. And frankly, equity markets have been reluctant to sell off compared to the oil markets. And the oil has been calling its bluff, right? So whatever socialism with Chinese characteristics means, which appears over and over again in Xi Jinping's speech, maybe it means what's happening in Shanghai right now, where you have to get a PCR test 48 hours before you even enter a store or dine at a restaurant. Maybe that's what it means. I think there are fundamental issues here with China's growth prospects, as well as doing trade with them in terms of our companies that are multinationals over here. So I think there's definitely a fundamental reason for the sell-off.
Let's think, therefore, what we do going into next year. How defensively should one be positioned? If so, what does that defensive position look like? I'm wondering how you deal with all the uncertainty right now. Uncertainty is very hard to price, Anna.
Right. And it's difficult to not only price, but also to position. So defensive is definitely the theme going into 2023, and actually also finishing out 2022. And that actually has been our focus for most of 2022. And the focus definitely has been on cash flow. So we're talking about dividend-paying stocks, focus on value-oriented styles and sectors, and clearly fixed income. I know that has been everyone's favorite topic, because for the first time in a really long time, we have respectable income coming out of fixed income. We are in fixed income still short duration because the Fed is still raising rates. Going from 75 basis point hike to 50 doesn't mean that they're actually dovish or that there's a pivot. Cost of borrowing is still going up. So we are still cautious there in terms of duration. And an inverted curve environment, short term definitely is the name of the game in terms of income.
Do you like equities? And if so, where?
Equities, definitely. We're expecting there to be an earnings recession. I know that the outlook is a little bit more optimistic for 2023, while Q4 2022 is a little negative. We think that's a little bit too optimistic, considering the fact that the Fed is hiking into an inverted yield curve. So we are definitely defensively positioned. If we're talking about sectors, that would be consumer staples, utilities, and healthcare. We do like cyclical sectors, despite the fact that there would be a short-term headwind. So things like industrials, we are gung-ho on American manufacturing, especially with the deglobalization theme, but certainly staying cautious on more speculative stocks, such as tech and communication services.
Anna, really great to catch up. Thank you very much indeed. We really appreciate it.
Thank you.
Anna Rathbun of CBIZ Investment Advisory. Thank you. Bit of breaking news out of New Jersey. BlockFi and 8 of its affiliates have commenced voluntary cases under Chapter 11 of the U.S. Bankruptcy Code in the Bankruptcy Court for the District of New Jersey. The company will now focus on recovering all of its obligations to BlockFi by its counterparties. Now, this, of course, includes FTX, quite intertwined. We'll get more details on how this story is going to develop. BlockFi International filing in Bermuda for joint liquidators. That's the latest. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The CEO of Barclays will be undergoing treatment for non-Hodgkin lymphoma. CS Venkata Krishnan says that doctors have told him his condition is curable and he expects treatment to last 12 to 16 weeks. He plans to continue running the bank during that time. The main privacy watchdog for Meta in the European Union has fined Facebook's parent $277 million for a massive data breach. Meta was penalized for failing to prevent the leak of the personal data of more than 500 million users. The fine was imposed by the Irish Data Protection Commission. And turmoil at Apple's key manufacturing hub in China will be costly. Bloomberg's learned that the unrest is likely to result in a production shortfall of close to 6 million iPhone Pro units this year. The company that operates the facility, Foxconn, is trying to get workers back to assembly lines after those violent protests against COVID restrictions. And that is your latest Business Flash, Alex.
All right, thanks so much, Radhika. All right, coming up, you got oil sliding to its lowest level in nearly a year, but the question really is why and what the trigger is. Are we just selling winners here for the year, or is there a real fundamental issue here? Demand China is going to be key, as well as what's happening with Russian supply. We're going to get more on those setbacks for the crude market coming up with Christian Malik of JP Morgan. JP Morgan just downgrading its Brent forecast for next year by about $8. We'll break down the why. This is Bloomberg. We're about an hour into the U.S. trading session, really rolling over here now. The S&P's up by 0.7 around the lows of the session. Abigail Dula tracking those moves for us. Abby?
Well, Alex, it's really interesting here, this divergence that we're seeing here for U.S. stocks, that S&P 500 down 0.7%, as you were talking about, and energy, one of the big declining sectors, ExxonMobil, along with oil, although oil appears to be off of its lows. The NASDAQ Dragon Golden Index, on the other hand, is up 3.6%, not exactly what I would have expected, given the fact that we do, of course, have those protests in China over the COVID zero policies. And one of the big reasons why Pinduoduo up 14%, its best day since March of 2022 of this year, on what analysts are calling a blowout quarter. So that seems to be raising some of the other stocks there. Plus, you have some of those casino operators upgraded, receiving their gaming licenses, also helping out. But let's see whether or not this narrows on the day between the world's U.S., the largest economy, and the second largest economy. Now, relative to China and that unrest, or of course is a Bloomberg exclusive, reporting today that relative to Apple, there could be maybe a 6 million iPhone Pro deficit. That stock down about 2%, really dragging on the complex overall. Some of the other chip companies related to Apple down. Now, this is very interesting. Two indexes coming from some of our folks from the markets team, Dan Curtis and Pete Diateris, that the stocks, the companies that are related to those that have more international sales, well, they are not doing as well this year, down 12.3%, whereas those companies that are more domestic based, yes, they are down, but down less, down 8.2%. And finally, bringing in the commodity complex. Now, oil has just been so amazing. So here is the parabolic uptrend that we were tracking earlier this year. Typically, technically, these do have to reverse. It took a while here as the buyers and the sellers really kind of duked it out. But at this point, we are now down on the year at the lowest level, Guy, since January of this year. Of course, dollar strength, a piece of it, but also the question around demand on a slowing economy. Some talking about the idea that we will be in a slower a recession early next year, and that could really weigh. And then plus China, the world's largest user of natural resources.
You've got a lot of Russian crude still kicking around on the market as well, and that might not be going anywhere. There's a number of factors here. It's a pretty complicated picture, Abigail. Thank you very much indeed, Abigail Doolittle. All of this, of course, does today at least have China at its center. So let's get back to that story and how it could impact the global energy markets. We're joined by Christian Malek, JP Morgan, Global Head of Energy Strategy. Christian, let's talk a little bit about how you think about pricing the China unrest into the crude market. There seems to be a huge amount of uncertainty here. How are you thinking about it?
Well, I think ultimately China's been a cause for concern for several years. Whether you had the trade war, now you had COVID, and now you have a reopening that's going to potentially be at risk. The way I think about this is as follows. As China continues to sort of move in stops and starts, while that's clearly sort of quite bearish on the short-term end of the part of the structure, what it fails to sort of recognize is ultimately supply. We're in peak year for supply crude globally. So we stick behind our super cycle oil call that oil will be well above $100 over the next few years. But ultimately, we're ebbing and flowing around these short-term supply-demand misses, particularly around China being very difficult in terms of recovery as we hadn't expected.
So, Christian, what I find really confusing is if you take a look at global stockpiles, they're still quite depleted. If you take a look at product stockpiles, they're still really depleted. Yet the sentiment has been so bearish. And I'm wondering just literally, and this is a dumb question, why is crude so much lower?
You're not wrong to ask that question. I think ultimately there's a lot of dark inventory, probably the best way to put it, with flows from Russia, flows from Iran, sanctioned barrels, which were taken on very quickly in the start of the war. Now that demand hasn't come through, particularly in China, those volumes are boomeranging back into Europe. So the physical market's actually is struggling to find a bid. And then you have sort of overlaid onto that speculators who've bought into price caps and potentially a removal of Russian barrels. That also isn't playing out because Russian barrels have actually been very resilient for the course of this year, and we expect that to continue for next year. So you have the risk premium unwinding into a sort of physical surplus, but that doesn't speak, that's almost deceptive in itself because it doesn't speak to what the fundamentals talk to, which is huge deficits up to 2-3 million barrels, as we've been arguing for the best part of 2 years, out in 24, 25 and 26. So you could look at this as more sort of temporary or transient pullback. And I'd say one more thing, the more volatility you have at the front end, particularly with China weakness, the more it just pushes capex and supply out in the medium. So no one's spending, no one's investing in production. So ultimately you're fanning the flame for the back end of the curve. So you should start to see a flattening if at the very least.
Mm-hmm. Just to come back to the Russian barrels, is there now an expectation in the market that any price cap from the EU will have virtually no effect?
I think ultimately, I would say there's still some degree of pricing. I think ultimately OPEC are looking at this effect of a price cap and sanctions as they look at the calculus of whether to cut or not into next week's meeting. I would argue that most of that risk premium is now gone, Guy. I think the expectation is that Russia will stay resilient. However, what people I think is not being considered is what's Russia's retaliation function. What are they going to do? Are they going to propose more cuts into the OPEC meeting in order to get the price up, in order to aggravate if the price caps actually go into law and the compliance is relatively high?
Staying on government stuff, Is the Biden administration going to be buying at these levels? I mean, they said they would. 65, 72. Do you expect that to be happening? Some SPR replenishing here in the U.S. to support the price?
It would make complete sense. Oil is very cheap, both in historical context, in terms of where we see it moving over the next few years. If there's a time to buy and get in front of it, it would be now, particularly as that sentiment, as you point out, Alex, is exacerbating the price. We don't have the clarity around demand going into next year. So you have a sort of superficial range, so to speak, that they should be taking advantage of. I don't think it's going to last very long. So we'll see what their actions are, but ultimately we've got to decide: are we in the early innings of a super cycle? Is this a cyclical, moving into a structural transition where you have multiple year deficits, or are we in the later part of the innings where the best is behind us? We clearly are in the former camp. We think we're just getting started, but depends on how they perceive the market, whether they see this as a real deficit or not.
If I'm an income investor short term, is there any risk to that income?
If you're looking at income in the majors, you've got 20% yields across the European majors, which I've known my career seen. And those yields underwrite one simple thing, that the back end of the curve is still robust, and the cash break-evens, the price to cover their capex and dividend, is so much below. It's actually half where the oil price is. Whether it's 80, 90, 100, these companies are spitting out cash and returning it to shareholders. So if anything, the buy case arguably is less so in the commodities future, but more in the equities, where you're taking advantage of those yields.
So to that point, though, if crude continues to get hit, do oil equities get hit percentage for percentage, or is that link going to be a bit different?
I think that link's going to be different. I think the decoupling's already started. I think the European majors are holding up, so the US. You may start to see a correction given US is really decoupled to oil prices and held up probably too well. But within the European context, given how much cheaper they are, if they're trading at half the valuation of the US majors, I'd argue for a increasing decoupling within the European energy equities, particularly to low oil, and particularly as their cash break-evens are so much lower. They're trading on the back end of the curve, which continues to stay supported by the lack of supply.
If we get a slightly weaker dollar from here, and the dollar's already given back some ground, Christian, do I want to own US majors or European majors?
I think ultimately you're right about the currency, but given the valuation, typically Europe trades at around 40% discount to US. Now it's trading on almost 100%. Those two have to converge somewhere between around 60%. So if we're right around that convergence, whether the dollar strengthens or not, I personally think that convergence will happen as we see underweights in Europe buy into European energy through the correction in oil prices and the outperforming yield that will continue. I don't see why that would change. Particularly this as well, they're not spending, they're not investing. The capital discipline will continue into next year and the year after. So all that excess cash flow goes to the shareholder, and that's why the yields are so high. And then,
Christian, does it go to governments? I mean, it feels like the political risk in Europe is much stronger in terms of all these windfall taxes that we're getting. And I'm wondering if the share prices are already discounting that, and if not, where's the downside?
I think if we see further windfall taxes, you're right, that will contract some of that free cash flow. But let's put it this way. If windfall taxes go up by another 10 to 20%, if they double, your free cash flow yields will go from where they are currently, around 25% down to 17, 15%. So you're still getting massive excesses of free cash flow. So windfall tax is not something that we can ignore, but I think the worst is behind us. And you're also seeing elevated cost of capital. So these companies were derated into so much baggage around windfall tax and other sorts of pressures, and so we're not arguing necessarily for a re-rating, we're just asking for that cash flow, that yield to contract. So most of the worst is behind us. If we see more windfall taxes next year, we still see that kind of cash return coming, so take advantage of that discount through windfall tax. I think it's almost a buying opportunity. And the last thing I'd point out is the more you tax these companies, the more you restrain capex, the more you restrain supply in the future. We're at peak year globally for crude oil supply. So ultimately, you're just going to end up with a better quality, higher back end, which ultimately is good for the majors because they trade on the back end. So there's sort of an action equal opposite reaction to supply that doesn't get factored in as we think about equities.
Right. No, that's a fair point. And sort of the back end of the curve is going to be higher because of your super cycle thesis, hence buy equities. Hey, Christian, really appreciate it. Always wonderful to get your perspective. Christian Malek, JP Morgan Global Head of Energy Strategy. All right, coming up, we're going to take a look at how protests in China are going to be affecting supply chains next. We talked about equities, we talked about ego, we talked about oil. We're going to talk to Mark Manduca, GXO Chief Investment Officer next. This is Bloomberg.